Hi there, Phil Hall here in Washington, D.C. That building behind me is the headquarters of the Mortgage Bankers Association. On today's show, we're going to be speaking with David H. Stevens, President and CEO of the Mortgage Bankers Association. Come on along. David H. Stevens, how would you categorize the current state of the housing industry today?
Well, look, clearly the housing market is not recovering the way we would have expected. We have a market that's probably going to be flat or down over last year in terms of total home sales. There's a lot more behind that discussion. We're seeing strength at the higher end of the market. So, anybody who's involved in sort of the jumbo market or in wealthier communities, those markets are recovering a lot faster than the entry point. So first-time home buyers, sort of the entry-level price point is actually down fairly significantly over a year ago.
Is there any surprise that the recovery has been as lethargic as it is?
Yeah, I mean, if you just look at core demographics, you've got this sort of millennial generation, which has obviously been talked about quite a bit, but it's very large. And the percent of 30-year-olds, for example, that have mortgage debt today is down about 10% from where it has been traditionally. So, first-time homebuyers just aren't coming into the market right now. Yet you juxtapose that against a recovering economy. You have interest rates still near record lows. You have the home affordability index that groups like the National Association of Realtors produce, showing that the rent versus buy scenario has almost never been better to own a home. So it defies what most expectations were from a year ago when you look at economic forecasts of what home sales growth was going to be. We're not meeting those expectations. So it's a bit of a surprise, absolutely.
In demographics, there's also a bit of a wild card with the nation's minorities and the immigrant population. What impact are they going to have on housing?
Well, it's going to be the most extraordinary shift in household demand. So just take this one point in context. And this is from the Kennedy School at Harvard Joint Center for Housing Studies. They put out a study every year called State of the Nation's Housing. But if you look at existing housing stock in this country, residential housing stock, 70% of it is occupied by white non-Hispanics. So that tells you the nature of home ownership and housing today. If you look over the next decade, in terms of the growth of new housing stock that's going to be created, new household formation, only about a third of that is going to be white non-Hispanic, and the remainder is going to be minority. So we're moving to a country that's going to be majority minority, but in terms of home sales, it's going to be vastly majority minority by about 2/3 of all home sales. So really changes a lot of things, changes the type of housing. It really impacts things like standard qualification measures and sort of a qualified mortgage rule. Makes you question whether that kind of sort of square peg, square hole thinking is going to work for the new type of home buyer coming into the marketplace. Self-employed borrowers, family members living together, multiple jobs, overseas sources of funds. I mean, it really puts a lot of new issues into the limelight in terms of how we think about financing new home ownership.
A lot of people I've spoken to in the industry have expressed concern over consolidation among mortgage companies. Is that something to be genuinely concerned about?
The challenge we have today is with all the impact of the regulatory measures that have been put forth, the focus on compliance and quality control, in-house legal counsel. These are sort of new things that companies have had to now consider that they didn't necessarily have to consider in years past. Raises the expense base fairly dramatically, and so we always talk about this too small to comply question. Is there a point at which you're perhaps not large enough to be able to have the appropriate risk protections in place to offset your fixed infrastructure, and you need just more revenue coming in, meaning more loan officers in a larger company? At some level at the entry point, at the lower end of the particularly independent mortgage banker space, we've seen a lot of merger and acquisition taking place. That being said, there's a sweet spot in the independent mortgage banker community, particularly where sort of the mid-tier and larger independent mortgage bankers are actually taking advantage of this marketplace. We're seeing them grow, adding offices, taking over branches. So there's going to be some level of merger and acquisition that I think we should expect. One from that standpoint, likewise, just through a consolidated market that's contracted from $1.7 trillion in production last year to down to about $1 trillion this year. And I don't think any of us can really predict where that'll stop from where it has started already.
You mentioned QM and complying. This past year and even going into next year as well, mortgage bankers have more than enough regulatory considerations to deal with. How is the industry holding up under this regulatory burden?
Well, from my own perspective, I think this is a case of just overcorrection. One of the hardest things about this is the rules are not applied evenly. So, the treatment of bank versus non-bank in terms of how points and fees are disclosed. In many ways, it's confused the market and confused the public, and it's picking winners or losers in terms of business models. So, very difficult.
Well, I've known some smaller lenders, including community banks, have said it's become almost too expensive for them to originate loans.
Absolutely. I mean, that comes down to this too small to comply discussion. Small community banks, there's about 4,000 community banks in this country that have done some form of mortgage lending. And in many cases, these may be single branch, local community banks in places like Ridgefield, Connecticut, or in Oklahoma, or Kansas, or Iowa that have a branch in a small community. They may do 50, 100, a couple hundred loans in a year, but at the cost it requires today to maintain a compliant operation, particularly as a bank where you have either federal regulators or bank supervisors overlooking your risk, it becomes very difficult. And so we are seeing many community banks, particularly at the low end of the production level, exit the business entirely.
Well, here in Washington, you're in touch with all of the regulatory agencies, particularly the CFPB.
Right.
Are they cognizant of the problems that the mortgage originators are facing in terms of trying to keep up with the compliance burden?
Yeah, so at the risk of getting a lot of hate email, I actually think Rich Cordray, who heads the CFPB, is doing a great job. There's a lot of room for improvement, and it's as a big regulator implementing so much change. It's clearly anything that gets implemented of this scale is going to have problems. But Rich is also very open. He uses his ears, which is great for a regulator. He puts everything out for notice and comment and gets feedback from industry. I'll just take one example, the qualified mortgage rule. I mean, look, there are definitely issues we have with the QM rule and things that could be improved. But there's a safe harbor in that rule that had he listened purely to some of the more aggressive consumer advocates, there wouldn't have been a safe harbor in the rule at all. And so, I mean, there's an example of where he's listened to industry and adapted measures in some of these rulemakings because he was open to that kind of input.
Also, in fairness to Mr. Cordray, the CFPB is a new agency, so he's just basically going into brand new territory. He's not inheriting an older agency.
That's right. Well, the interesting thing about Rich is what I always remind people of, he didn't create the Bureau. The Bureau was created under the Dodd-Frank Act. The Bureau was going to exist one way or the other. The goal out of that kind of environment is to try to get as many people, or at least knowledgeable about the industry as possible. I think what many people are worried about, and many lenders in particular, are the teams that are coming around doing examinations in their offices. But interestingly, to date, we've seen very few actions taken from those examinations against lenders. There have been some, but relatively few considering the number of exams that have taken place. So can't say that's going to last indefinitely, and I think we need to be very active and actively involved with the Bureau to make certain that they don't overreach. But so far, I think they've been measured in what they've done, and we do need to make changes to some of these rules that have been put out. And I think we're going to enter that phase now in terms of how do we modify rules to make certain we're not blocking out well-qualified borrowers from being able to get a mortgage.
I have another Washington-related question for you. GSE reform.
Sure.
To put it briefly, what happened?
Well, look, that was a bill that has to go through Congress. So if we look at what Congress has produced over the last 6 years, you could ask that about a whole lot of things. Just like how hard it was to get flood insurance done. But I really worry that the industry doesn't understand what conservatorship legally does and how it restricts the possibilities. So this idea that we're going to sort of keep Fannie and Freddie or put them back the way they were is really not a feasible option. They're in conservatorship now. Their capital is winding down, so they have no capital to draw from. in the event they need a draw, which I believe is going to happen with at least one of the GSEs over the next couple of years, the potential for a crisis response from Congress to really clamp down becomes more dangerous. And then finally, the most important aspect here, Phil, is that they're operating under an explicit guarantee on their mortgage-backed securities. In their previous role, they operated with an implicit guarantee. That's really important in terms of how the international markets would respond if they were put back the way they were. And to make the explicit guarantee permanent is going to require some form of legislation. So I'm a strong advocate for GSE legislation. We got to get it right. But this current state in no man's land where they sit right now isn't really helpful to expanding credit, opening up opportunities to bring in more lenders, and get the housing market moving forward. So
well, it seems unlikely that it's going to have any GSE reform this year, especially until the election comes about.
Right.
When do you see it actually happening? Do you see it in the next Congress or even the Congress after that?
You know, look, I'm a guy who's been in the mortgage business for 3 decades, and I came in Washington to take the role in FHA. But I'm realistic enough and pragmatic enough in Washington not to bet on legislative outcomes. I will tell you this, that if the Democrats retain the Senate after the fall elections, there will be a lame duck session. And if the Democrats retain that control of the Senate, I think there's a possibility that more work could be done on this Johnson-Crapo legislation to improve it and make it a workable bill, and potentially get it through a full Senate vote. So that at least could get it through one side of Congress. That could propel some activity into the next Congress to try to reach some form of compromise with the House. But if the Senate flips and goes Republican in the fall elections, I think the likelihood of any progress in the lame duck becomes less so. They'll want to wait till they take full control of the Senate in the new term. And I think any work that gets done at that time probably means a reform measure for Freddie Mac and Fannie Mae that actually could even constrain them even further. So there's a lot of work to be done. And this is why groups like the MBA exist, is you got to fight the fight in DC and make sure that we can be actively engaged so that the outcome at least means that we have a functioning industry.
Well, you're here in DC fighting the fight, but mortgage bankers around the country can also get involved as well through your alliance.
Absolutely. So, what people don't recognize is that you can be a member of the Mortgage Action Alliance and it doesn't cost you a penny, and you don't have to be a member of anything. And so it's free. You go to just type in Mortgage Action Alliance on a Google or website, and you'll see our webpage, and you can sign up. The reason why that's important is when there's something really bad happening that's going to be voted on, if you can get 1,000 or 2,000 or 3,000 calls made suddenly from people around the country, practitioners who are doing this business every day, it really has an influence on the votes. And I've learned this firsthand. You can truly influence an outcome legislatively and stop something terrible from happening or promote something to get done. There's a points and fees bill, which many of your readers are aware of, that we're trying to get through Congress. And we've done calls to action, as we call them. And we've reached out to the thousands of Mortgage Action Alliance members, but we need tens of thousands more to join. So if you're anywhere in the system as a loan originator or processor, appraiser, it doesn't matter what you do in the business, title company, you name it, join the Mortgage Action Alliance. It's free. It allows us to at least let you know when something's going on. You can choose to participate or not on the particular issue. Really important area, though.
And the folks on Capitol Hill do listen when people call and email.
No question. When you visit the Hill and you go visit a member of Congress's office, you'll see a couple people at the front desk. They're just answering phones all day long. They're registering those calls. And when you talk to a member of Congress, they'll tell you what their constituents are saying to them, because that's how they get reelected, and they're very conscious of a massive outcry on any particular issue. So it definitely has an impact, and you can't underestimate the power of a single voice.
Well, last question I would have for you. We're taping this now in early September with a lot of folks going back to school. For the mortgage bankers of tomorrow, why would anyone who's currently in college and looking to graduate at the end of the semester want to consider a career in mortgage banking?
Yeah, it's a great question. And I've had this question from mortgage banking executives who are so worn out as a result of what's happened over the last few years. Why would anybody get into the business? I'm a huge active proponent of young people getting into the industry. In fact, we're just starting an endeavor with colleges and universities. I've hired an individual to bring our School of Mortgage Banking programs to colleges and universities around the country. Let's be pragmatic about all this. The echo boom generation, this new generation coming into the housing system right now, biggest generation in history, bigger than the baby boom generation. Housing starts are going to be extremely strong. The Harvard Joint Center predicts there'll be 14 plus million new households over the next decade alone. Everybody's going to need a mortgage. Everybody is going to live somewhere, whether they rent or they own. It comes with a mortgage. If you think about any kind of product sales over the next decade, if you want to predict an absolute sure thing, we have a massive growing population that's going to live somewhere, and those properties will need a mortgage. And you'll either get one for yourself, or you'll rent and pay somebody else's mortgage who got a mortgage. And so the demand is going to be great. It's an amazing profession. If I could, Phil, I'd just tell you, I came into this business in the very early 1980s when rates had just peaked at 18% was the FHA rate when it maxed out. And when I came in, I joined a community bank, and all the loan officers who I was working with had been through the crisis of the oil patch crisis and rising rates and a dead housing market, and they were all telling me, why are you getting into this business? It's terrible. Many of them left. Well, I stayed in that business for 3 decades. I originated a whole bunch of mortgages. I made a personal career out of it. And I think we're in that kind of cycle now. There's a lot of people who may say, don't come in, it's been a terrible time. It has been a tough few years. But the future of mortgage finance is very strong, and that's driven purely by the demographics of housing demand that is absolutely going to be there. So it's a great profession to get into.
David H. Stephens, thanks so much.
You bet, Phil.
This is Phil Hall for The Housing Show. Peace out.
The Housing Show airs every Friday at 11 a.m. Eastern Time and can be viewed exclusively on MortgageNewsNetwork.com. Thanks for watching us here on Mortgage News Network. You could be part of the action here. If you have a product or service for mortgage professionals, you can be a sponsor and have your commercial here on Mortgage News Network. And if you don't have a commercial, that's okay. We have plenty of clever and creative folks behind the camera who can make a commercial for you. For more information, please send an email to info@mortgagenewsnetwork.com. Or for immediate info, please call Beverly Bolnick, our National Sales Manager, at 516-409-5555, extension 4. And she'll tell you how you can be part of the action.
This is Mortgage News Network.